I'm Grant Mercer. This is Storm Stock Solutions, and we're getting you set up before the opening bell. Let's bring some clarity to the chaos as we head into today's trade. The tone this morning is all about two competing forces: a surprisingly firm U.S. labor market on one side, and growing concern about how much optimism is already priced into markets on the other. According to reporting from MarketWatch, jobless claims have dropped to a more than 3-year low in what's being called a no hire, no fire economy. Companies aren't really adding workers, but they're also not laying many off. That kind of data tends to keep the Fed and bond markets focused on whether growth and inflation might stay stickier than forecast. At the same time, there's a broader macro debate around inflation and forecasting itself. Mark Hulbert at MarketWatch highlights how traditional market forecasts are often wrong, and points to inflation-linked investments as a way markets see the future of price pressures. That keeps the spotlight on real yields and inflation expectations as quiet but powerful drivers of equity valuations. Layered on top of that is a story from Jeff Ferry on America's affordability squeeze, the Unaffordability 5: housing, food, healthcare, childcare, and energy. Those costs have been marching higher for years, long before trade wars or the latest tariff headlines. For equity traders, that's a reminder that consumer sentiment and lower to middle-income spending power can be under real pressure, even when headline GDP and employment look fine. It's a backdrop that tends to favor value-focused, budget-oriented consumer plays and raises questions for more discretionary, higher-ticket retail. On the stock-specific side, Oracle is one of the names in focus this morning. Emily Berry reports that sentiment around Oracle has quickly deteriorated heading into earnings, largely on concerns about financing needs and the cost of capital. One analyst expects Oracle to clarify those financing plans and potentially show that the requirements are less demanding than Wall Street fears. For traders, that sets up a classic expectations game. Expectations have been walked down, so any reassuring tone on balance sheet and eye on cloud growth could shift sentiment quickly, while a cautious or vague update could reinforce the downbeat mood. Now let's talk about where strength is showing up on the radar. In retail, Dollar General is an early standout. According to Tommy Kilgore's reporting, the company is seeing more customer traffic than key rivals, with sales topping expectations and some evidence it's taking market share. In an environment where affordability is front and center, investors often watch these value retailers as a barometer of stressed consumers trading down. The fact that traffic is up and the stock is rallying tells you where shoppers are gravitating and where the market sees relative resilience. In big tech, Meta is in the headlines again, this time for regulatory reasons. The European Commission has accused Meta of violating EU antitrust rules, as Steve Goldstein reports. On the surface, that sounds like a negative, but the market reaction has been more nuanced. These kinds of cases can hang over a stock, but they're also usually long, drawn-out processes. Traders are watching whether this escalates into fines or forced changes to the ad and data model, or whether it settles into background noise. For now, it's a reminder that regulatory risk remains very real for U.S. tech platforms, especially in Europe, even as their fundamentals remain tied to digital ad spending and AI-enabled engagement. On the risk side of the ledger, that jobless claims story deserves a second look. Jobless claims at a 3-year low sound great on the surface, but in this no hire, no fire setup, it can also mean productivity and wage dynamics are doing more of the heavy lifting. If hiring is frozen but layoffs are rare, you can end up with slower job growth but still firm wage pressures. Bond traders will be asking whether that mix keeps inflation from falling as fast as markets hope. For equities, that can be an area to handle with care. Strong employment supports consumer spending, but persistent inflation pressures can cap valuation multiples and keep the Fed from cutting as quickly as some are betting. There are also some under-the-radar themes worth keeping on your watch list today. One is a broader sentiment call from strategist Warren Pies, highlighted by Barbara Kohlmeyer. After getting the big calls on stocks, bonds, and oil right this year, he's now warning about a potential optimism shakeout in early 2026. The idea is that AI adoption might broaden market leadership beyond today's megacaps, but before that happens, overly bullish sentiment might need to reset. Traders and longer-term investors alike may watch positioning data and volatility closely to see if we start to price in that kind of shakeout ahead of time. Another sleeper theme is around AI and corporate behavior, from a column by Mike Hoffman. The piece argues that some companies are pinning layoffs on AI when, in reality, poor leadership and bad capital allocation decisions are the underlying problem. That's a good reminder when you're scanning AI headlines. Not every AI restructuring is a growth story. Professionals often look through the buzzwords to the fundamentals: margins, return on invested capital, and whether management has a track record of executing. Stepping back, the macro and micro threads tie together like this. You've got resilient labor data, an ongoing affordability crunch for consumers, skepticism about forecasting, and individual corporate stories where expectations are either washed out like Oracle or surprisingly strong like Dollar General. That's the kind of mix that can produce choppy, range-bound index action with sharp individual stock moves. We'll see how futures digest all of this as we move closer to the bell, and once cash trading is underway, I'll be back with intraday updates to track how these themes are actually playing out on the tape. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.